Today, I wanted to talk about hidden Markov models, which I think are especially cool. We've had a couple pieces that are talking where we have talked about market regimes and sort of detecting them, and I wanted to kind of talk about some of the computational methods for actually doing that in a really interesting way. I'm trying to cover the math in an as surface level as possible. It is a pretty advanced strategy, but if you're ever curious about how to actually computationally sort of detect what volatility state the market is in, this is one way to do that. These are very interesting models. They're used in a ton of different areas of like engineering, computer science, not just finance, but they can be applied to finance as well. And we're going to talk about them. Let's get into it. So like I said, we've spent several segments discussing this idea of market regimes or periods that have sort of like their own unique properties, statistical properties that tend to propagate for a sustained period of time. And we've also talked about some common indicators that may show that the market has shifted regimes, specifically into a high volatility regime. Those high volatility regimes like the COVID crash, 2008 housing crisis, dot-com bubble, have kind of like the easiest, I would say they're kind of the easiest to spot, moving into those very rare, very extreme volatility conditions. And we've talked about some of those common indicators, such as increases in intraday or daily price volatility, high VIX levels, and increased correlations between major sectors in the market. We see major sectors like tech, energy start to become more correlated to the market during these periods, although obviously like gold and bonds, like there are ways to diversify against that increased correlation. But today I wanted to talk about a computational model that can be used to more rigorously detect those regime shifts and sort of the unique statistical properties that we sort of talked about, and they're called hidden Markov models. Okay, so first we're going to start talking about, just regular Markov models. So these are different state models. They're basically used to measure states of a particular system, specifically probabilistic systems that can kind of transition between different states. And we are going to assume that those systems follow a Markov process, which is it's called a memoryless process. Basically, we're going to assume that the probability of transitioning between these sort of different states in the system really depends only on the current state of the system. So we're not going to assume that the history kind of beyond that, the memory kind of beyond the current state, is going to impact whether or not the system kind of transitions between these different states. So for example, you could use a Markov model, and again, they can be applied to a ton of different types of problems. But for example, to detect that an engine has transitioned from an operational state to a dysfunctional or need of repair state. In our engine example, like, it's a probabilistic system. There's some probability that the engine's going to transition between states. But because we're assuming a Markov process, we're just going to assume that this transition between states really only depends on the current state of the system.
Okay.
That's what this memoryless term means. Kind of just a simplifying assumption that we're going to make. And that would be like, again, simplifying assumption for the system that we're dealing with. Make sense so far?
Yeah, with this example makes it clear.
Okay, good.
Thanks.
So we've talked about that is what Markov models are, but there are different kind of classes of Markov models, and the type of model that you're really going to use is going to depend on what system you're working with and how much information about that system is observable, and also whether the system can actually be adjusted based on those observations. So for example, can the functionality of the engine be directly observed, or does this kind of state transition between operational and in need of repair, does that have to be inferred by another variable like temperature? Like, is this, operational variable directly observable, or do we need to infer that the engine is most likely not operational because of some other variable that we can observe, like temperature, like maybe fluid detection, for example, or fluid levels? Yeah, make sense?
Yes.
And then as well, can we modify the system based on that information? So those are the kind of two factors that you would consider when you're determining what type of Markov model to use for your system. So when it comes to markets, hidden Markov models are typically what we would use. And so these are types of Markov models that are applied to autonomous systems or systems that cannot be modified by the agent. We're going to assume that while we're observing these different market states, that no agent who's observing them can impact the system, right? So because we're assuming no one market participant can really do that. And then we're also going to apply these models to partially observable Markov processes. So we're going to assume that the hidden state or the volatility state of the market is not directly observable, but it has to be inferred by some dependent and observable variable. And as I'll talk about in a second, we're going to use returns, like daily returns for the market, to kind of indicate what volatility state that we're in. But we're going to assume that the actual volatility state is not directly observable. Make sense?
Yes, especially with an engine example.
The engine example, right?
Yeah, we
That's what I'm
like.
saying. These are actually used a lot in different engineering problems, because when you're dealing with these types of state models, this is a big one. And so, like, when it applies to markets, there's hopefully some analogies that'll help us understand a little bit what's going on.
Yeah.
But that makes hidden Markov models appropriate for market regime detection because, like I said, the regime itself is not directly observable. We can't observe the volatility regime. We have to infer it. And we're also going to assume that we can't like actually impact the system at all while we're observing it. Yeah, make sense?
Yeah. Thank you for that one. Yes.
Okay, so in mathematical terms, right? So we got to use mathematical terms, right? Because we're trying to take daily returns and kind of assign a Markov state to them. We're trying to look at a daily return and build a model that's going to kind of attach for each daily return a volatility state corresponding to it. So for each time t, or for each day, right? 1, 2, 3, 4, 5, 6, 7, 8, 9, we're going to assume that the process can be described by some state z of t. So this is our hidden state zt, and we can't measure it, but we're going to use observation x sub t in order to do that, in order to infer what state that we're in. So as the underlying process is Markovian, the current state of current volatility state of the market really is only going to depend on the previous state and not the rest of the history. So we can kind of see what the evolution looks like. So we have our Markov variable, our hidden volatility state. Z1 goes to Z2 goes to Z3. So our volatility state evolves in time, and how that manifests is in these observable variables, daily returns that we can directly look at. So what we're going to try to do is kind of build a model to figure out, based on the observable variables that we're seeing, what Markov state we're in, and sort of like how it evolves in time, day by day, according to this Markov process. So I left out the math. I was going to show the actual, like, how you show the model, but I realized, or how you display the model, like the mathematical representation for it, but I realized that it probably wouldn't be very useful. So I'm just going to kind of outline what parts of the model, or what components, make up a hidden Markov model. So basically, first thing that we got to do is define the possible number of hidden variables ZT, or how many hidden states are there that the market could have. How many different possible volatility states could there be? And I'll give you a slide in a second to talk about, like, maybe how you would determine that. But first thing first, we got to figure out how many possible states there are. Number 2, we have to take the sequence of observations produced by the system. So now we have to figure out, like, okay, so we need observations to define our model, to sort of train our model in a way. And we need to figure out, like, what observations to give to it. So that you kind of run into an interesting problem when it comes to backtesting, which is, like, how much data do I feed into this? Do I want to feed 15 years of data? Do I want to feed 10 years of data? Do I want to feed 5 years of data? Because obviously, like, the market's different day by day. If maybe my time window is too long, then it might misrepresent more recent events or more recent market changes, for example. But generally, we want to feed a good amount of data into it, because we're assuming that the market kind of cycles between these different regimes. So we want to feed, I usually use at least 15 years of data, so that the model can hopefully recognize some of the nuances that are similar between regimes. But now we need our observations. We need the initial state distribution of the system, which describes the probability of the system beginning in a current state. And there are algorithms that you can use on the training data to sort of figure that out. So this isn't something that you would really need to feed it in. You really just feed in the number of states and the observations. You need a transition model, which is basically a model that describes the probability of transitioning between states across these different time steps. And you need an observation model, which basically describes the probability of making an observation for a given state. Because remember, we cannot directly observe the state. We need to infer the state from what we can observe, which are our returns. So there's a probability basically that we have to assign to that, to, as to whether or not we got that right. Because again, there's that extra step of the fact that we can't observe it. And there's a sort of like error associated with that, a potential error associated with misassigning because of it. So we want to look at the probability that we ultimately assign the state correctly. That has a separate model associated with it within this hidden Markov framework. Like I said, so the models that comprise the actual hidden Markov model are estimated from training data using different algorithms. So there's like mathematical mechanisms for basically figuring all of those out. You don't have to estimate those yourself, but you as the user really have to determine what data to feed into it. And there's a little bit of nuance in terms of like how or what you would feed into it. So maybe determining that. I usually use just a very large collection of data, but there's a little bit more nuance in figuring out like how many hidden states you're typically going to define. And it's really going to depend on the case, although there are additional computational methods for actually figuring that out. There's really no universally accepted number of market regimes, but it's generally accepted that there's somewhere between 2 and 4. And recall that when we're talking about market regimes, we're talking about a bear market is a market regime. It's got its own unique statistical properties, and it tends to propagate for a sustained period of time. A bull market, a crash, a sideways market. These are examples of market regimes. And typically there's between 2 and 4, maybe 5 is what we accept, although there's no definitive number that we know of at least. And the exact number that you use is really going to depend on the type of analysis that you're performing. But the risk that you run is that the more regimes that you set, if I say like there's 5 market regimes, you run the risk of overfitting. So you might have like more granular information about these market regimes because you got 5 different market regimes and you can classify specific information and granular information about each one. But overfitting is a problem when basically you have a model or a strategy that works really, really well for your historical data, but doesn't work well in the future in general. So that's why you might want to use a smaller number of market regimes where maybe you have less information about the different possible regimes that the market can experience or undergo or move through. But you might be able to, from that smaller number, develop a strategy or develop a model that's a little bit more robust for future use. So you kind of balance things out a little bit. I'll usually use 3 kind of low, medium, and high volatility. I'll show an example of that, but that's just a consideration that a quantitative researcher or someone who's doing this kind of quantitative analysis would have to worry about. So, for example, if we, again, so we're using this Markov model, and again, you would use really like computational packages to do this. It's a pretty advanced strategy, but if you were ever curious about how you could potentially use math to define market regimes, which is a very difficult thing to do, this is really one way to do it. So again, we're using kind of returns values as our observations. This is data from 2010 to present. And what you can see here is the Markov model identifying 3 possible volatility regimes. So I put n equals 3, right? Or 3 possible volatility states, which kind of correspond to like low, medium, and high volatility. Kind of assuming as well that each regime is kind of normally distributed. That's another assumption that kind of comes out of this. But what this does is it gives kind of a real-time indicator whether or not the market is in a low, medium, or high volatility regime. And you can kind of see that here, like crashes are kind of highlighted in red. We can see like the 2020 COVID sell-off. We can see both the drop and the whipsaw on the way up, the very high volatility market. We can see that with the bear market of 22, where we saw some pretty steep sell-offs to the downside. And then we can kind of see mixed in, we have like the period from like 2017 to 2019, like a very strong bull run, a low volatility bull run at that. And then on the flip side, you can see like the medium volatility regime. So periods that are overall looking pretty bullish, just because the market is bullish on average, but with more volatility than what you would see in a lower volatility regime. So this is just an example. There's a ton of different ways to sort of apply and use these models, as I've talked about. But in terms of getting real-time indication, right now we're in a low volatility regime, funny enough. But in terms of getting real-time indication of what type of market we're in, this is a way to sort of use math to kind of more rigorously estimate that. Just because you can identify what regime we're in a little bit more precisely doesn't necessarily translate into knowing how to trade in the regime. They're right, especially those high volatility regimes. Because when we're talking about like super duper high volatility, we're talking about like the Great Depression. We're talking about the 2008 housing crisis. We're talking about the dot-com bubble popping. We're talking about the COVID crash. We're talking about really, really specific circumstances that caused the market to go crazy in very different ways. So just because you can identify what regime we're in, it doesn't mean you can necessarily translate that into strategy. And I kind of talked about this idea of overfitting, like different research considerations that you would have to use, like research nuances that you'd have to take into account if you were actually trying to backtest a strategy for this. But it's still an immensely helpful model, I think, especially for quants. So some takeaways. So there's strong evidence that the market shifts between different volatility states, and they each have their own sort of unique statistical properties and tend to exist for a sustained period of time. State models, such as hidden Markov models, may be able to identify these different states and detect transitions between them in real time. However, while certain models may be able to identify these regimes, developing and adapting strategies according to regime shifts is much more nuanced. One that I arguably haven't figured out yet. But it's a really interesting research problem, and next week I kind of want to talk more about like what that actually looks like. If you were actually to run a back test, what kind of things would you have to worry about? As well, like what would you want to pair something like this with? Like, would you want to pair this with technical indicators? Maybe volatility traders want to pair this with like the VIX or IVR or IVP. But it's still, I think, a really interesting tool and a really interesting application of this model that would typically be used in like engineering and applying it to trading, which I think is really neat.